Hello there, and welcome to Intermediate Accounting 2, Chapter 21, Accounting Changes. We're going to go through Part 1, which is talking about the types of accounting changes, and then the next video, we'll go through Part 2, talking about error analysis. So what we're going to do is we're going to go through each of the types of accounting changes. So this is after you've done your financial statements for the year, and then next year, or the next year decide to change something. So you decide to change the way that you are doing your accounting policy, maybe that you changed an accounting estimate, or you correct a prior period error. So you found out that there was error in a prior period and you want to correct that. So we're going to go through what are the three different types of accounting changes, and then we're going to go through the accounting methods of each change. So when you know you have this certain type of change, what do you do? How do you account for it? And then we'll look at some journal entries on how to account. So the types of accounting changes, we have a change in accounting in an accounting policy. So that's going from one acceptable accounting policy in either IFRS or ASPE to another acceptable accounting policy. So an example of this is going from, when you're looking at revenue, going from percentage completion method to completed contract method. Or when you're looking at inventory, going from weighted average to first in, first out, or the other way around. So it's looking at, if you have a certain policy of the way that you're accounting for something, you want to change that. The next one is change in accounting estimate. So here, the way that you're estimating something is going to be changed. So for example, your allowance for doubtful accounts. Last year you used 5% of AR in your allowance, and now this year you want to use 7%. So that would be a change in accounting estimate. And the third one is correction of a prior period error. So after the year end is done, the books have been closed, financial statements have been finalized. After that point, you find an error in the prior period financial statements. So how do you go about correcting that? So let's look at each one of these changes in more detail for a greater explanation for each one. So for this chapter, what you need to know is you need to be able to just distinguish between the three types of changes. So if you see a scenario, you need to make sure you know that this is either accounting policy change or an estimate change or a correction of a prior period error. And that's really important because that also determines how you're going to account for it. So there's different ways to account for the different types of changes. So you want to make sure you know, are comfortable with what type of change it is first. All right, so changes in accounting policy, there are two different types of changes. There are mandatory changes and then there are voluntary changes. So a mandatory change is when IFRS or ASPE standards, like the standard group, says that, okay, you need to make a change. So they mandate and they make it mandatory to make a change. So I don't know if anybody remembers LIFO, but LIFO was another method to record, to value inventory. So it was last in, first out. So before, there was three types of methods. So there was four, I guess, because there's specific identification. So there's specific identification, FIFO, weighted average, and LIFO. So what ASPE and IFRS did was they got rid of LIFO, and they said you could no longer value your inventory using LIFO, last in, first out, and therefore whatever companies were using LIFO had to do a mandatory policy change and change the way that they were valuing their inventory to either FIFO or weighted average. Okay, so a mandatory change, there's something that's changed in the standards and you have to follow that. Another recent example is leases. So we looked at leases for IFRS 16, the fact that they had to record in asset and liability for IFRS. Before, a few years ago, you would recognize for the leasee, it would be recognized based on kind of how ASPE is. You would go through criteria and then you would decide whether it should be an operating lease or capitalized. But now most leases are capitalized. So companies would have to make that policy change. And then you can also have a voluntary change. So companies management can decide that we want to change from percentage completion to completed contract method, or we want to change from FIFO to weighted average. So this is the company making the decision that they want to change the way that they're doing their accounting for a specific account. The only way that they can make a voluntary change if the change provides reliable and more relevant information to financial statement users than the previous method. So you can only make a voluntary change if it provides more relative information to, I should have written here, to financial statement users. So you can't, companies can't make a change in order to have, a higher revenue, for example. The change has to be reliable and provide more relevant information to financial statement users. So this, whenever there's accounting policy change, it has to get disclosed, and you have to explain the reason for why you're changing it, and the reason has to be to provide better information for the financial statement users. One other thing to note is you want to make sure you recognize when something is a new policy versus a change in policy. So new policy is going to be dealt with in a different way than a change in policy. Okay, so if you're going from one way of doing something to another way of doing something, that would be a change in policy. If you've never had the transaction before, and this is the first time you're having the transaction and you're introducing this new policy, that's not going to be a change. You're not changing the way you're doing something. It's just that you've come up with this new transaction, and therefore you have to apply the policies with it. So an example of that would be if you're constructing a building for the first time, under ASPE, you need to decide if you want to capitalize your interest cost or you want to expense it. So if they choose to capitalize it, but they've never done that before, it's not like they're changing from expensing it to now capitalizing it, which would be a change in policy. It's a new policy because it's a transaction that they've never done. So make sure you just know the difference between a new policy and a change in policy. So this chapter talks about accounting policy changes, not new changes. Next one is a change in accounting estimate. So when you do a change in accounting estimate, you do it based on new information or experience. So experience with the company. So I gave the example of allowance for doubtful accounts. So say in your first year, you say, oh, my employees are going to my customers are going to be really good. They're going to pay me on time. So then you would take your allowance is, let's say 5% of AR. Okay, so you set up your allowance at 5% of AR. Then a couple years go by and you realize that your customers aren't as good as you wanted them to be. So they're not really paying you very well. There's a bunch of bad debts. So maybe you change your estimate from 5% to 15%. So that is a change in accounting estimate based on experience or new information. So the more experienced you are with the company, with your customers, that's how you are able to change your percentage based on what your customers are actually like versus what you thought they would be like. Right? Or any new information that comes into play. If you find out that, like COVID, for example, like maybe because of COVID, your customers aren't paying you as much as they usually would in a good economy situation. So that's new information that leads you to maybe change your estimates. All right, so examples, I talked about uncollectible AR or allowance for doubtful accounts. Other examples are warranty provisions. So at the end of the year, you would need to make an estimate of how much the warranty is going to cost the company. So how many people are going to come and take advantage of their warranty and get a new product or something. Fair value of your assets. So if under IFRS, if you're using the revaluation method, you are going to record your capital assets at the fair value amount instead of the cost amount. So estimating the fair value, that could change based on experience or new information. So that would be a change in accounting estimate. And depreciation as well. Depreciation would also be classified as a change in accounting estimate. So under depreciation, you have your residual value, right? So your residual value is an estimate. So if you think you're going to get $15,000 after the use of like equipment, for example, after you finish using it, and you realize during the years that you're using it that you probably won't get 15,000 because of all the wear and tear that's going with it, then you would have to change your estimate for your residual value. Another one is your useful life. Okay, so useful life. So maybe when you first get the asset, you think it's going to last you 5 years, but you've taken really good care of it and it's lasting longer than you thought, so it's going to actually last 7 years. Okay, so that would be a change in the useful life. And your depreciation method is actually also an estimate change. So whether you're going to do straight line, right? So your depreciation method is whether you're going to do straight line or double declining. So whether you're going to do these, which one you do, that's actually an accounting estimate change. Some people get this confused with accounting policy change. So they think going from double declining to straight line method is a accounting policy change, but it's actually accounting estimate change. And the reason for that is you base the method on the pattern of usage. So you would use straight line if you think that the asset's going to depreciate at the same amount each year, or you use double declining if you think that the asset's going to depreciate faster at the beginning of the years and slower at the ending years. So if that changes, so if you think that it should be straight line, but then you realize based on new information or experience that it's actually depreciating a lot faster than you would think at the beginning, then you would change it to double declining. Okay, so pattern of usage is an estimate that you're doing. Okay, so the residual life, useful life, and the method, whether it's straight line, double declining, so it changes. Without our machine hours, one of those as well. And then the last one is a correction of a prior period error. So these are omissions or mistakes that have been made in a prior year, and you figure it out after the year has ended and after the financial statements have been finalized. So here, this could be either intentional or an honest mistake. Okay, so there could be an intentional mistake, which could be something to do with fraud, right? So the management of the company could be intentionally increasing the revenue of the company in order to show more revenue than there actually is. So that would be an error, but it's due to fraud. Or it could be due to oversight. So someone wasn't checking properly, somebody just made a critical error, somebody just missed a number or something like that. So examples of this could be mathematical errors, not adding things up correctly or multiplying them up or not adding the correct numbers. Transposition errors. So a transposition error is writing 74,000 instead of 47,000. Okay, so just mixing up the two numbers there. Okay, so that could be a transposition error. Allocating an item to a wrong account. So saying something is the popular one for this one. Allocating an item in the wrong account. So, something was supposed to be in a capital asset, but you put it in, let's say, like you put it in prepaid or something, for example. Capitalizing out an item when it should have been expensed. So you put something in capital asset when it should go into repairs and maintenance. This is a popular one. A lot of companies end up putting something in capital when it should have gone in repairs and maintenance, or the other way around, right? So so these are the examples of different types of errors that could happen. All right, so those are the types of errors. So make sure you know or get comfortable with when something is an accounting estimate change, when something is a policy change, or when something's a correction of a prior period error. And then depending on which type of change it is, we're going to have a different accounting method for each one. So the accounting methods, one way to deal, I'll show you which methods apply to which changes in the next slide. But one accounting method is retrospective or retroactive application. And then there's two different types. There's full restatement and partial restatement. So a full restatement, okay, so let's make a timeline. So let's say you started your company in 2011, and let's say now we're in 2020. Okay, so you started your company in 2011. In 2011, you started recording revenue using the completed using the completed contract method. Then in 2020, you decide that I want to use the percentage completion method because it's going to provide better information to my users. So under retrospective full restatement, what you have to do is, so you can't go back and actually change the financial statements from 2011 to 2019 because that's done and those books are closed, they've been put away. But what you can change in 2020 is your retained earnings. So your retained earnings is going to be the number that's going to have all the numbers from all the net income from 2011 to 2019 in there. So your retained earnings amount is what you're going to change in 2020. If you're doing full restatement, what you're going to do is you're going to go back all the way to 2011, figure out what your net income would be. So figure out what your net income would be if you were always using the percentage completion method. So if you're always using the percentage completion method in all of these years, what would your net income be? And whatever the total net income for all of those years would be, you would have to change retained earnings in 2020 to reflect that. So what you're doing is you're pretending that this whole time I was using percentage completion method, and if I was using percentage completion method this whole time, what would my net income look like each year, which results to what would my retained earnings look like in 2020. So full restatement means go back all the way to 2011 or go back all the way to when you first started using the accounting policy. So when you first started using completed contract, and change retained earnings for what it would be if you were always using completed contract, always using percentage completion. Okay, so that's full restatement. That looks like a lot of work to go back all of these years and figure out what your revenue would be and your net income would be. So there's also retrospective application with partial restatement. So that means, okay, maybe you can't go all the way back, or it's impractical to go all the way back to 2011. Maybe you don't have the records from 2011, right? CRA says you only have to keep your records for 7 years. So maybe you don't even have records from 2011 to be able to do a full restatement. So what partial restatement says go back as far as you can and change your retained earnings for 2020 based on if you're always using partial percentage completion method for as far as you can. Okay, so let's say that we can only go back to 2014. So we wouldn't have to go back all the way and change and figure out what our net income will be and what the new retained earnings should be for 2020. We're just going to go back to 2014 and do that. Okay? So partial restatement says go back as far as you can. So as far as you have the data, as far as you can actually do the calculations. Partial restatement says at least go back 1 year in order to have comparative financial statements. So you would at least try to go back 1 year. An example of companies only going back 1 year is when there was a policy change. All public companies had to follow IFRS. So that is a policy change. That policy changes use retrospective. So companies weren't going back all the way from when they started operations and determining what your financial statements would look like if they were always using IFRS policies instead of ASPE. So what they did is they went back at least 1 year. So they did a partial restatement and went back 1 year. So if it's impractical, it's going to cost you a lot of money. It's impossible to go back all the way. Then go back as much as you can, at least 1 year. And then we also have something called prospective application. So you can it's either going to be retrospective, full if you can, partial if you can't, or it's going to be prospective application. Prospective application means if you change something in 2020, going forward, you're making that change. Okay, so you're just making that change going forward. You're not going back and changing anything from previous years. You're not changing your retained earnings for 2020. So prospective means going forward, you're making the change. Retrospective means you have to go back and make the change or determine what your retained earnings would be if you made that change. Okay, so those are the different types of accounting methods you would use, and then we'll match them up to the changes. Okay. So if there's a change in accounting policy and it's a mandatory change, so we said going from LIFO to either FIFO or weighted average. So if it's a mandatory change, the other big one is going from GAAP standards to IFRS. So those are a lot of changes, mandatory changes that companies had to make. What you're going to do is usually if there's a mandatory change, the standard is going to tell you what method you have to use. So if it's a mandatory change, the standard will say, okay, you have to change this. You have to change it from LIFO to FIFO, and you have to do retrospective application. Okay, so the method usually is stated when the accounting standards bring out this mandatory change. If there is no method stated, then for accounting policy changes, you're going to use retrospective with full restatement. So if you can, you have to do full restatement. If you can't, then you would do partial. And you would have to disclose why you're not going all the way back, right? So why you're just doing a partial. If you can't do retrospective at all, not even in partial retrospective, if you can't even go back 1 year because it's impractical or you just won't have accurate numbers, then you can do prospective, but only if you can't do full or partial retrospective. If there's a change in accounting policy that's voluntary, so the company's decided that they want to make the change, then you do retrospective full first. If that's not possible, then do retrospective partial. If that's not possible, then you do prospective. If there's a change in accounting estimate, so going from 5% uncollectible AR to 10% uncollectible AR, you deal with that prospectively. So going forward, you just make that change. Okay, so the reason for this is because, because the changes are based on it's based on new information or new experience with the company. So that's new information that you never had last year when you did 5% uncollectible AR, for example. So you were not going to go back and change something when you didn't have that new information. So just going forward, change your allowance to 10%. You don't have to go back and change anything from the prior years. If there is a correction of a prior period error, what the accounting standards say is they say do retrospective. Okay, so they say do retrospective. They don't really, IFRS doesn't really give you an option to do prospective, but I think ASPE says that if that's not practical, then do prospective. Okay, so do retrospective full is what you need to do for correction of a prior period error, but if that's impossible to do, then you would do partial. If that's impossible to do, then do prospective. But usually for errors, you would do full retrospective. So go back to when the error first occurred and see how your financial statements would be different if that error never happened. Okay, so go back to when the error first occurred. All right, so let's try to do question 1. So if you go into your chapter 21 class exercises, and we can do that here. Okay, so we have our question 1. So the question 1 goes through what type of change is this and what is the accounting method applied. And there's a legend down here that says, is it a policy change, estimate, error, or none of the above? And the accounting method, are you only accounting for it in the current year? Are you doing prospective? Are you doing retrospective, or none of the above? So what I want you to do now is pause this video and try each of these questions and think about what type of change it is and what the accounting method is, and then you can unpause it again and go through the solutions. Okay. All right, so change in a plant's assets residual value. So if anything in depreciation changes, that's always going to be in estimate change. And estimate changes, you're always using prospective. Okay, so prospective. Change due to an overstatement of opening inventory. So I guess your code or your hint word here is overstatement. So there was an overstatement of opening inventory. So that must have been an error. So somebody made an error and that led to an overstatement. When there's an error, you're going to deal with it retrospectively. Changing from the sum of the year's digits to straight line method for depreciation because of a change in the pattern of benefits received. Patterns of benefits received. So again, this is a change in depreciation. It's not a change in depreciation because it's an error. It's because there's been a change in the usage, the patterns of the benefits received. Okay, so sometimes it might look like an estimate change, but somebody actually made an error and that's why it's wrong. But in this case, so you want to look at the reasons. So what are the reasons why they're making the change? And that's going to help you decide what type of change it is. Okay, so in this case, it's an estimate change. Estimate changes are always dealt with prospectively. Change in a primary source of the gap. So something in the rules have changed. So this looks like it would be a mandatory change. So it would be a policy change. Policy changes are dealt with the method stated. So whatever the method stated is, if there's no method stated, then you would do retrospectively. So first check what the standards say of how to account for it. Next one, decision by management to capitalize interest. The company is self-reporting, self-constructing a building for the first time. Okay, so your hint is first time. So they're doing this for the first time, and they decided that they're going to capitalize interest. So they're not actually changing something from what they were doing previously because they've never constructed a building previously. So it's not like they were expensing interest and now they're capitalizing interest, which would be a change in policy. This is actually a new policy, so it's not a change. So none of those 3 types of changes would apply here. And in this case, it's NA because it's not a change. So in this case, just going forward, you would just capitalize your interest. So just make sure that you're not confusing something that's a change in policy with a new policy. Next one, change in the rate used to calculate warranty costs. Okay, so you're changing the rate used to calculate warranty costs. We don't have enough information to explain whether this is an error, but it looks like they're just changing the rate. Maybe they're saying 5% of sales and now they're saying 10% of sales. Okay, so that would be an estimate change. Estimate changes are always prospective. Next one, change from an unacceptable accounting policy to an acceptable accounting policy. So I think your hint word here would be unacceptable. So they change from doing something unacceptable or wrong to doing something acceptable. So in this case, that would be in error because they were unacceptable means they were doing something wrong. Errors are applied retrospectively. Change in a patent's amortization period. Again, when there is amortization, it's usually an estimate change unless they did it because of an error. And prospective. Change from zero profit method, so that's completed contract method, to percentage completion method on construction contracts. This change was a result of experience with the project and improved ability to estimate cost of completion. Okay, so this one, if it just said this first sentence, then I would look at this and say, okay, this is a policy change. You're going from completed contract to percentage completion. So that's why I had said earlier, you have to look at the reason for the change. Okay, so the reason for the change was because of experience and approved ability to estimate the cost. So maybe they always wanted to use percentage completion, but they didn't because they couldn't estimate the costs. And now they've gotten experience and now they can estimate costs. So this one's actually an estimate change. So like I said, the first sentence, if it was just the first sentence, I would say policy, but you have to look at the reason why. So with new information or experience, that would be an estimate change, and you would deal with it prospectively. And the last one, recognition of additional income tax owing from 3 years ago as a result of improper calculations by the accountant who is not familiar with income tax legislation and income tax returns. So your hint here is improper. So someone did something wrong because they weren't familiar with the income tax legislation. So that one's pretty straightforward. It would be an error. Errors are dealt with retrospectively. All right, so I hope these make sense. Once you start getting the hang of things, once you realize that looking at the decision of why they're doing this, why are they making the change, that's going to help you determine what type of change it is. Okay, so let's continue with our PowerPoint. All right, so now that you know how to determine what type of change something is, and you know the accounting method that should be applied, let's actually apply the method and show you what the journal entries are going to be like. So how do you actually apply prospective method? So an example here, a company bought machinery in 2013 for $872,000. This has been amortized straight line with a useful life of 6 years and no residual value. At the end of 2016, management decided that the useful life should be 8 years based on the machinery lasting longer than originally assumed. Okay, so first off the bat, what type of change is this? So the machinery ended up lasting longer than they originally assumed. So this is based on experience. They realized that it's actually lasting longer. So that would be an estimate change. Estimate changes are always applied prospectively. So how do we apply this prospectively? So we're going from 6 years to 8 years useful life. We bought this machinery in 2013, but now it's end of 2016. So going forward, we're gonna have to make this change. So we don't have to change anything from 2013 to 2015. Just 2016 onwards, we'd have to change it from 6 years to 8 years. So to do that, the first thing you need to do is find out how much has been depreciated so far. So first thing you need to figure out is what is the net book value, right? This is not staying on its books at 872. It's going to be 872 less accumulated depreciation from 2013 to 2015. So we want to know what's the opening net book value. So opening net book value as of 2016. And then we can take that opening net book value and then depreciate it over those 8 years instead of the 6 years. Okay, so what is the depreciation? So question, I should probably tell you what the question is. What is the depreciation amount for 2016? So what we're going to do is first figure out what has been depreciated so far. So what's been happening so far is they took in 2013 to find out the depreciation, they took the 872 divided by the 6 years. So every year for 3 years, so for 2013, for 2014, and for 2015, they've been depreciating 145,333. Okay, so the total depreciation so far, or the total accumulated depreciation, is 438,000. So if we started off with 872 and we have accumulated depreciation of 436, what is our net book value in 2016? Well, conveniently, it ends up being 436. So that's your net book value opening in 2016. And then now that we know what our opening net book value is, we can figure out our depreciation. Okay, so then we would take this number and divide it by how many years are remaining. So we had 8 years altogether is what we want to change it to, but 3 years, 2013, 14, 15, have already gone by. So we're going to depreciate the rest over 5 years because we have 5 years left. So instead it should be, the useful life should have been 8 years instead of 6. So it's not that we have 8 years left, it's we have 5 years left because 3 years have already gone by. All right, so just the calculations there. So 436 divided by 5 gives us 87,200. So our new depreciation for 2016 onwards is 87,200. And we don't have to change what we did in 2013, 14, or 15 because this is an estimate change dealing with it prospectively. All right, so hope that makes sense. So the depreciation, for 2016 is this 87,200. All right, let's look at another example. So like for the rest of this chapter, the best way to learn is just to look at the examples. So there isn't too much technical. Working through the examples is the best way to learn this chapter. Okay? So a company bought machinery in 2013 for $325. Management discovered in 2016 that the machinery was actually expensed in 2013, despite the fact it had a useful life of 10 years with a 10% salvage value. This should have been depreciated using straight line. Okay. So they expense the whole full 325 when they should have depreciated it over 10 years with a 10% salvage value. So first thing you need to figure out, what type of change is this? So they did it wrong. So this is an error, and errors are always dealt with retrospectively. Okay. So the question is, what is the depreciation for 2016? And what is the journal entry to correct this? So when we're doing retrospective, what we have to do is go back to 2013, figure out what the error was, figure out what would have happened if the error never occurred. So if everything was correct, what would your routine earnings in 2016 look like? Yep. All right, so let's work through this. All right, so a good way to do this when you're looking at errors is look at what happened and what should have happened. Okay, so this first column is what actually happened versus what should have happened, and then you can kind of figure out what to do. So what happened, so what was expensed? So if you look at what was on the income statement, in 2013, they expensed the full 325,000. And they didn't expense anything in 2014 or 2015. Okay, so now we're in 2016. So we're just looking at what happened in the rest of those 3 years. What should have happened is they had 325,000 minus your salvage value of 10%, so 32,500. And they would have divided that, they would have divided that by 10 years. So what should have happened is there should have been, so this should have been the depreciation each year. So if you just calculate how much depreciation should have been, so each year they should have expensed 29,250 instead of the full 325. Okay. So by the time we get to the beginning of 2016, they have expensed 325,000 when they should have only expensed 87,750. So if you look at if in total they expense 325, but they should have only expensed 87,750, what's wrong with their net income in those 3 years? So from 2013 to 2015, their net income is understated because they expensed 325 when they should have only expensed 87,750. So it's understated by 237,250. Okay, the difference between those two. So if their net income was understated all those 3 years and net income flows into retained earnings, by the time we get to 2016 opening, your opening retained earnings is also understated by this 237,250. So what we have to do is we have to bring up retained earnings. So we have to change the retained earnings amount in 2016 to reflect this error. So if retained earnings is understated, in order to bring it back up, we need to credit the amount. So we're going to credit retained earnings for the 237,250. And we don't have this 325 in our assets, right? This was fully expensed, so we don't actually even have an asset of 325. So we have to put in an asset of 325, and that asset of 325 should have an accumulated depreciation of 87,750. So this is a journal entry we have to do in 2016 in order to fix this error. So we have to bring machinery into our asset account. We have to show accumulated depreciation thus far, and we have to fix our retained earnings. So retained earnings of 237,350 needs to be credited because retained earnings is too low. Right? So it's useful for you to do a chart like this of what happened, what should have happened, so you can kind of figure out what's the entry to fix it. And then in 2016 again, and then in 2016 going forward, you would just use this new depreciation or the calculated depreciation. So you would debit depreciation expense, credit accumulated depreciation, 29,250. So you would do that in 2016 as well. All right. Okay, so let's look at a couple more examples. Like I said, it's best to just go through different scenarios, different examples for the rest of this video. Okay, so let's go through question 2 and then we'll go through question 3. So question 2 shows us that this company bought equipment, and this is the details of it. They bought a building. These are the details. And it's saying the equipment was depreciated using double declining method for the first 3 years for financial reporting purposes. In 2014, the company decided to change the method of calculating depreciation to straight line for equipment because a change in the pattern of benefits was received. No change was made to useful life or residual value. It was also decided to change the building's useful life from 30 years to 40 years with no change to residual value. The building is depreciated on a straight line method. So the questions are: prepare the journal entry to record depreciation expense for equipment and depreciation expense for the building. So what I want you to do now is pause this video, go through this question yourself, figure out what the depreciation amounts are, and the journal entry for that, and then you can unpause this video to look at the solution. All right, so let's start with equipment. So equipment was using double declining method for the first 3 years, and now they've decided to change it to straight line because the change in the pattern of benefits received. So the type of change this would be an estimate change. So it wasn't an error or anything. They've just, with experience, the pattern of benefits received has changed, so they're going to change this. So for the first 3 years, they were doing double declining. Okay, so what you want to do first, calculate how much depreciation was taken this far, calculate the net book value at the beginning of the 4th year to figure out how do we change this. Okay, so you can do like a little chart, what your depreciation was, what your net book value was. If you call how to do double declining method, if it's been a while, double declining method is what you do is you basically take your cost or your net book value. You take your net book value divided by the 5 years times 2. Okay, and that's going to give you a percentage. Okay, so your net book value, well, we could see, divided by 5. Oh, sorry. Sorry, what you do, I was just doing the actual amount. What you do for double declining method is you take 100% divided by the useful life, and you multiply that by 2 times 2, so 40%. Okay, so double declining is you take 100% divided by your useful life times 2. Okay, so you might want to note this formula. Okay, and then you get a percentage. So that percentage you're going to multiply with your net book value every year. Okay. All right, so now that we know how to do that, so 40%. So we're going to take our cost multiplied by 40%, and that's going to give you your depreciation of 186,000. Okay, so I'll show you that. So 465, which is our first year net book value, times 40%, 186,000. Then you're going to figure out what's your ending net book value in 2011. So it's your 465,000 minus whatever depreciation you've taken. That would be your net book value in the first year. And then you're going to do the same thing. So in 2012, you're going to take your 297,000 times 40%. So that's 111,600. Then you're going to take this 279,000 minus 111,600, and that's going to get you 167,400. And then lastly, take your 167,400, multiply it by 40%, 66,960. I take that minus the 167. So in total, the depreciation amount is 364,560, and your net book value at the end of the 3 years, or at the beginning of 2014, so the beginning of the 4th year, is 100,440. So now going forward, so this is because this is an estimate change, we're going to deal with this prospectively, which means going forward, we're going to make that change. Okay, so going forward, we're going to use the straight line method. The straight line method incorporates the residual value. Okay, so if you have 100,440 left, minus the 15,000 residual value, and since 3 years have gone by already, there's only 2 years left. So divided by 2 years, and you get depreciation expense of 42,720. Okay. Part B talks about what's the depreciation expense for the building. So, or what's the new depreciation expense in the 4th year. So here, what they decided to do was change the useful life from 30 years to 40 years. And it looks like this was an estimate change. It doesn't say that it doesn't say it was an error, so we can assume that's an estimate change. So what we do is first, again, figure out what the net book value is at the beginning of 2014. So if it was useful life has been 30 years so far, 780,000 divided by the 30 years gives us how much is the depreciation each year. Multiply it by the 3 years that have already gone by, to find out what your how much your total depreciation is, and then minus the 780 to find out what your net book value is. Okay, so I've done that here. So depreciation per year, if you take your 780 and divide it by 30, 26,000 for all 3 years, that's 78,000, which means the carrying amount is 702,000 as of, I guess, opening 2014. Now your useful life is 40 years, but 3 years have already gone by, so you're only going to depreciate this over 37 years instead of 40 because 3 years have already gone by. So that's 18,973. So that would be your depreciation going forward. Estimate change, you don't have to go back and change anything. Just going forward, you make that change. All right, so let's go on to question number 3. Question number 3 says that this is the first audit of the books of Gomez Limited. It was recently carried out for the year ended 2014. They follow IFRS, and examining the books, the auditor found certain items that have been overlooked that might have been incorrectly handled in the past. Prepare the journal entries in 2014 to correct the books for the 6 items below and identify the type of change for each of the items. Okay, so they're doing the audit right now for 2014, which means 2014's books are still open. So you can still make changes to 2014 numbers. Okay, so just keep that in mind. So pause this video, go through this question, go through each of the 6 scenarios, and then determine what the journal entry is to correct the books. All right, number 1. At the beginning of 2012, the company purchased machinery for $450,000 with a residual value of $45,000 and a useful life of 6 years. The bookkeeper used straight line depreciation, but failed to deduct the residual value in calculating the depreciation amount for the 3 years. Okay, so let's think about what did they do? So how much depreciation was actually taken versus what should have been done. So what they did was they just took 450,000 divided by 6 years, and they had depreciation expense of 75,000 each year. What they should have done is they should have taken the 450,000 minus the 45,000 residual value and then divided it by 6. So if they did that, the correct amount would have been 67,500. So 75,000 is what they depreciated, 65,500 is what they should have depreciated, which means this is an error. They failed to deduct residual value. If it's an error, we have to deal with this prospectively. So we actually have to change the retained earnings in 2014 to account for this error. Okay, so we've actually taken too much depreciation. So we've taken 7,500 extra depreciation than we should have. So what we have to do, so our books are still open in 2014. So in 2014, we can fix our depreciation expense. But 2012, 2013, the books have been closed. Okay, so we would have to adjust the retained earnings for that. So we took too much depreciation. If we took too much depreciation, our net income was too low, which means our retained earnings is also too low. Okay. So we have to bring up our retained earnings, we would have to credit the retained earnings. Okay, so let's look at the journal entry here. So we're going to credit retained earnings for the 2 years that it was too high by 15,000. In 2014, the books are still open for 2014. We did depreciation expense of 75,000, but it should have been 67,500. So we can actually just reverse our depreciation expense in 2014 by 7,500. And then the total of those two would have to go into accumulated depreciation, because we would have taken too much out. We would have credited too much accumulated depreciation, so we have to just debit that out. All right, so that's scenario number 1. Scenario number 2 says that at the end of 2013, the company had accrued sales salaries of $36,000 in excess of the correct amount. So they accrued an amount higher, $36,000 higher than it should have been. Okay, so what's the journal entry to correct this? So what you want to try to figure out is, what did they do? So what is the journal entry that they did? And that's going to help you figure out how to correct it. Okay, so maybe we can write out what they did. So what they did was they would have debited, so when you do an accrual of sales salaries, you would debit salaries expense and you would credit salaries payable, right? So that would be your accrual that you would have done. They did it for $36,000 more than they should have. Okay, so they debited $36,000 more expense than they should have, and $36,000 more payable than they should have in 2013. So now when you get into 2014, if there was too much expense in 2013, so if there was too much of expense in 2013, that means in 2013 your net income was too low. That means your retained earnings is also too low. So to increase your retained earnings, we have to credit. So we're going to credit retained earnings, 36,000. And then we also have this payable that's too high. Salaries payable stays on your books, right? It's in part of your assets. So then we can get rid of that. So salaries and wages payable is too high. So we'd have to debit that out. So this looks like it is an error because they did it too high, which means that we would have to do retrospective. Number 3, a tax lawsuit that involved the year 2012 was settled in late 2014. It was determined the company owed an additional $73,000 in tax related to 2012. The company did not record a liability in 2012 and 2013 because the possibility of losing was considered remote. The company charged the $73,000 to retain earnings as a correction of a prior period error. So you need to go back to the rules around contingent liability in order to be able to understand what they did here. So under the rules for contingent liabilities under ASPE, this is an IFRS. Let me just double check. Yeah, they follow IFRS. So IFRS calls it provisions. So when you're talking about provisions under IFRS, you are to record a provision for a lawsuit if it is probable that the company is going to have to pay money in the future. Okay, so if it's probable that the company has to do a payout, then you would have to record a liability for it. So it says the company did not record a liability in 2012 and 2013 because the possibility of losing was considered remote. So they didn't think that they were going to lose a lawsuit. So it wasn't probable that they were going to lose a lawsuit, and therefore you don't have to record an entry, a liability. Okay, so they did it correctly. They said, we didn't think we would lose, and because of that, we didn't record a liability. They would have just disclosed this. So there actually wasn't an error because their estimate just was not accurate, but at that time, with all the possible information that they had, they thought that they wouldn't lose the lawsuit. But 2014 comes, they actually did lose the lawsuit. So when they lost the lawsuit, they took $73,000 and charged it to retained earnings. So they would have debited retained earnings, and they called it a correction of a prior period error. But it wasn't a correction of a prior period error because they did not actually have to do a liability in 2012 or 2013. So we have to reverse basically what they did. So they debited retained earnings. We'll have to reverse that. Okay. And then we're going to debit current tax expense because this has to do with owing additional taxes. Right. So sometimes you need to remember the rules from your other accounting courses to figure out if this is an error or not an error. All right, number 4. Gomez purchased another company in early 2010 and recorded goodwill of $450,000. Gomez amortized $22,500 of goodwill in 2010 and $45,000 in each subsequent year. This is another question where you need to know what the rules are around goodwill. So if you remember from your intermediate accounting 1, do you amortize goodwill or do you not? So the answer there is you do not amortize goodwill each year. Goodwill is assessed for impairment, but you do not do an amortization for it each year. Yeah, so this company amortized goodwill when they should not have been. So again, we can look at what did they do versus what should they have done. So what they did was they amortized $22,500 in 2010, and then 2011, 2012, 2013, and 2014, they amortized for $45,000. So you can do a chart again to determine what they did do versus what they should have done. So I can do that just to show you. So 2011, 20, and 2014. Okay, so what they did, so how much, so what the depreciation was. So the depreciation was $22,500 in year 1, and the rest of the years it was $45,000. So that's the depreciation that they took. But they shouldn't have. They should have done depreciation of 0 all these 4 years. Sorry, all these 5 years. So we're in 2014 right now, so we can actually reverse our amortization entry in 2014 because we're still in our 2014 year. So for that one, we just credited amortization expense. So this is for 2014. For the rest of the years, we have to figure out, add this all up. So if we took more amortization than we were supposed to, then net income for all those 3 years would be too low. Retained earnings is too low. So we have to bring retained earnings back up. So we have to credit retained earnings. So the total of all these 4 amounts is $157,500. So we're going to credit that. And we're going to put these amounts back into the total amount back into goodwill because goodwill should not be amortized. So either goodwill or maybe they did accumulated amortization. So we don't know if they charged this directly to goodwill or had an accumulated amortization. So you could do either or because we don't have enough information here. Okay, so it's really important to know the rules, to just remember from your previous accounting courses what the rules are so you know that, hey, they did this wrong. Okay, number 5. In 2014, the company changed its basis of inventory costing from FIFO to weighted average. The change's cumulative effect was to decrease net income of prior years by $39,000. The company debited this cumulative effect to retain earnings. Weighted average was used to calculate net income for 2014. All right, so they changed from FIFO to weighted average. So that would be a policy change. Policy change, you do retrospective. They said the change's cumulative effect was to decrease net income from prior years of $39,000. So what they did is they did the exercise in figuring out if we were always using weighted average, what would the amount be? Like how would that affect our net income all those years? And they said the total amount that would have affected our net income is $39,000. So it would have decreased net income by $39,000. So what they did is they debited retained earnings to account for that. So if net income should be lower, then that means retained earnings in 2014 should be lower. So a debit is the correct amount. So they handled this change correctly, and therefore we don't have to do any entry. So they did this correctly. All right, last one here. In 2014, the company wrote off $87,000 of inventory that it discovered in 2014 had been stolen from one of its warehouses in 2013. This loss was charged to a loss account in 2014, right? So it was charged to a loss account in 2014, but does it relate to 2014? So the inventory had been stolen in 2013. So if it had been stolen in 2013, the loss should have actually been recorded in 2013. But it wasn't because they didn't figure that out. So that's an error. So the inventory was overstated at the end of 2013, but they didn't know this until 2014. So the loss actually occurred in 2013, and that means that the entry or the loss should have been charged in 2013. Because there was no loss in 2013 when there should have been, that means that net income is too high, right? So net income is too high in 2013, which means opening retained earnings in 2014 is too high. So to bring it back down, we have to debit that. And because this was charged to a loss account in 2014, and it shouldn't have been because it's relating to 2013, we're going to reverse this loss. So we debited the loss, so we're going to credit the loss now. So I'll show you the last journal entry. So this was an error, debit retained earnings to show that it was a prior period error, and then credit loss to get rid of the loss in 2014. All right, part B, we kind of answered while we were doing it. All of them are errors except for number 5, which was the policy change, going from FIFO to weighted average. All right, so I hope these examples kind of got your brains rolling and helped you understand what type of journal entries we would do when there are accounting changes. All right, thank you for listening, and stay tuned for part 2. Take care.